if you can buy in now at a reduced basis because there's already been a correction, and you're buying into a solid asset with a solid business plan and an experienced operator, now's a good time to look for those opportunities.
The majority of people trade time for money in the hopes of building wealth. I'm here to tell you that the traditional methods don't cut it anymore. Welcome to the Passive Income Power Podcast. My name is Doug Earthman. My partner Mickey Bernstein and I are going to dive deep into the power that passive income can have on your quality of life. We're going to discuss alternative assets, strategies, and insights through interviews with the very people who have found freedom through their power. I hope you enjoy this episode of the Passive Income Power Podcast. Thank you for tuning in to the Passive Income Power Podcast. I'm your host, Doug Earthman, and today we have our friend Aaron Yassin, who is an award-winning designer and founder of Hive Developers. He's going to talk about his knowledge and experience in the real estate development world of Brooklyn, New York. Aaron's a design-driven developer that builds ground-up multifamily in the city and has purchased, renovated, developed, rented, and sold properties with a current value of over $10 million. He's won multiple design awards and worked with world-renowned architects, artists, and designers. Did I miss anything, Aaron?
There's a lot of other stuff too. But that's great. It makes me sound really good. So.
Yeah. Well, just introduce yourself and love to hear about it.
Well, that's a great. Well, first of all, I'm excited to be here and have an opportunity to have a great conversation with you today, Doug. So thanks so much for having me on. I think you kind of hit on the bullet points from a resume standpoint. I think the one thing to add to that is that I'm coming into the real estate space from a unique position because my background and education is in fine art. So all my passion growing up and really still to this day is been in art and design, and that's the kind of thinking and my level of experience that I bring into the work that I'm doing in real estate and how I look at it and think about it. I see real estate as architecture, which it is, of course, but a lot of investors look at the real estate and then they look at the numbers.
Right. Spreadsheets.
Exactly. So there's actually something there. There's more to it, and it does inform the numbers, of course.
That's awesome. Yeah, it's very, very interesting. My mom's an art teacher, so I've grown up around art, very interested in design and drawing. And it's really neat that you're taking a little bit different of an approach than typical developers do. And New York, lots of fun architecture in New York. So
there's definitely more people that are working in this space and that have interest in high quality design. It's a driver in various markets in New York, and there's some operators that are excellent examples that really set the bar high, like a guy named Ian Schrager, for example. He's done a lot of hotels in addition to some other properties, and it's definitely something to aspire to.
For sure. Well, we met at a conference, I guess, about 5 months ago. And we hit it off from, I guess, day one. Really enjoyed hearing about your story, what you were doing in New York, and you were there really to promote a multifamily project that you are working on. Can you tell us a little bit about that?
So currently, my partner and I have two projects in process, but the project that you mentioned is the larger of the two projects, and it's a 10-unit ground up condominium development. So the exit strategy for the project is condominiums. We have purchased the property and we're moving forward with the project at this point. And the plans have been filed. We have a great set of plans, and it's an excellent location. As you can imagine, in Brooklyn, most of the properties have existing buildings on them. So we have two different buildings because we're combining two different lots, which gives us a much better site. But we've got two different buildings to demolish, which we should get started on in a few weeks at this point. So that just adds layers to the process. There's definitely more involved in building in the city than in some other places. But we're definitely very excited about it. We've got great layouts and a really nice mix of unit types in the building, and it's in a terrific neighborhood. It's really I still see it as the very artist centered neighborhood in Brooklyn, called Bushwick. It's the neighborhood has terrific diversity still. There's a lot of artists, and then other younger professionals, mostly in tech and other creative fields, have been moving in for the last 10, 15 years, and it's really emerged as a very unique Brooklyn neighborhood. So it's a neighborhood I'm excited to work in.
That's awesome. So you're tearing down two buildings. Coming from someone that loves architecture and design, are these buildings that have character that you're, I guess, at internal conflict about tearing down, or are they just like not, just tear them down?
That's actually that is a terrific question, because there's a lot to unpack there, because there certainly have been unique and valuable buildings particularly in New York, that have been torn down. I think that, the most controversial big teardown was the original Penn Station, that really set off a wave of historic preservation. Still to this day, I mean, that was part of the instigation of that, and there's a plan to kind of rebuild it now,
Mm-hmm.
because people still see it as such a tragedy. So it does bring up some of these very important questions. What we're tearing down is, we have a 100-plus-year-old wood framed house. It's a two-family house that's in terrible condition, that has really no architectural significance. We're not in a historic district. We're not dealing with historic property. And there are historic districts not so far from where we're at, over in the Bed-Stuy neighborhood. And there are some beautiful buildings there that should definitely not be torn down. So that's what we have, this two-story wood frame house on one side. And then on the left side, it's just a single-story brick garage. Literally, there was a mechanic shop in the space. They were the last tenant a couple of years ago, and there's no architectural significance to it. And we're really going to be significantly improving the site, and I think that has much more value than trying to keep what's there. That doesn't have that much value in terms of what it can add to the block and to the neighborhood and to the community. And I think that that's the case with a lot of buildings. And this actually it's a little bit of a segue to a point that I think is a kind of a bigger discussion, which is that there are a lot of buildings, not just in Brooklyn, but really all over the country, that just have outlived their usefulness. And I know there's a housing shortage in the country. And so there's a question, what should happen with some of these buildings? Is it better to try to renovate them and keep them so that we have more housing? What's really the best approach? And there's millions of buildings that really have little historic value. And there's also many of those buildings that not only do they have little historic value, they are also, detrimental to people's health. Buildings make people sick because of the materials that are used in the building, and I don't, that could be a full podcast on its own to discuss that. But when you have a lot of buildings that are at this point have outlived their usefulness, that no longer meet the kinds of standards we would like to see today, that we are much clearer now today, and they are also, in addition to that, making people sick. I think there's really a question of what we should do with those properties. And that's different than looking at, truly valuable historic properties that definitely should be saved and preserved.
Yeah, you say about buildings making people sick. The mold, lead based paint, asbestos. There's all sorts of stuff, and that's I have a background in environmental due diligence,
Right,
and so
right.
very very good point. And another thing I wanted to ask, and the alarms went off in the environmental side of my head when you mentioned that the back lot was a mechanic shop. Have y'all had to go through a bunch of environmental hoops, jumping through hoops? As far as I assume that you obviously got a phase one environmental assessment, and then because it's a mechanical or a mechanic shop, it probably warranted a phase two environmental assessment on top of that.
Well, I appreciate your knowledge in bringing this up, and this is actually, for anyone that's looking at a new development project or property, really any multifamily, because you never know what's under the ground, and it's possible to purchase an existing multifamily or a single family and not have looked into this, and then run into some significant problems later on because you uncover something that you were unaware of. So, this is really the kind of proper due diligence that you absolutely should consider doing, check into, and unless you're 100% sure that there's no risk to it, that phase one, should be done in many cases, many cases. So of course we're in the city, we have a commercial building, and yes, we did a phase one. But what's interesting in this case is that actually the mechanic shop presented no problem.
All right,
But
that's awesome.
that is awesome, but but there's a but here. The adjacent property on the corner was a dry cleaning
Oh, yep.
operation
Ding, ding,
for
ding.
exactly for many years, and there were some very harmful solvents that were used. They're typically not used anymore, but that were used
Yeah.
in dry cleaning operations, and so that history warranted a phase two. And of course, if people aren't familiar with a phase two, that's the phase one. Of course, there's a cost to it, which most people might find jaw dropping. But in terms of what's done on site, it's very little. It's mostly visual
pictures.
assessment.
Yeah,
Exactly. The phase two,
non-invasive. Yeah,
right. The phase two involves drilling. It's much more invasive. So, we had drilling done on site. They did vapor tests. They knew what they were looking for specifically.
sure.
And they did find, some evidence of some vapor from the PCEs. But, sort of the irony in the end of the process is that the required mitigation, which will really address the problem, this starts getting a little technical, is to install what's called a subslab depressurization system, which
Vapor mitigation, which takes the volatiles up to the roof and blows them out.
exactly. And but it's a very fancy description for something that's not that fancy. You basically
Right,
take a lot of
absolutely.
PVC pipes, you
And a
drill
little
bunch of
fan
holes
with a
in
motor.
them, right, and you bury them in the soil underneath, and then you put a vapor barrier on top of it, none of which costs very much, and then you
Sure.
run a PVC pipe up to the roof, and you may not even need a fan. Like there's an assessment required to determine if you do, and that's it. And it turns out that the mitigation, which will actually fully mitigate it to the appropriate standards, will probably cost about the same amount as the actual phase two inspection cost.
Wow. Huh.
So, it's like the same price to fix the problem as it did
Yeah.
to clearly identify the problem.
Wow.
So we did go through that full due diligence process, and fortunately, in our case, the solution is not a very expensive solution. Now, if we weren't completely demolishing the building and building a new foundation, then it would be much more difficult. How do you install a subslab system under an existing building?
Sure.
And there are other adjacent buildings that, where this vapor is a potential risk for people in those properties. So again, another really good reason to demolish the existing building, mitigate the environmental concerns so that they don't cause any harm, and put a new building on the site.
That's awesome. Yeah,
So
that's
thanks for
my
that.
language right
Right,
there.
right.
Is
Thanks for that question, because I mean, there's a lot of things that people should look for
sure.
when they're doing due diligence, and there are things like this that are often not considered, because there's so many things that you need to consider, right? Particularly if you're considering investing in a project, right? You're not the sponsor, you're not the operator. Have they considered everything? And knowing what questions to ask is really important. And I think that environmental questions or other similar related questions are often not asked. I mean, people that
Mhm.
are looking at existing multifamily to buy into, I would really caution people to try to understand, how what they're buying. Even if they're just investing 50,000 as a passive investor, are they buying a building that's making the people in the tenants sick?
Mhm.
Is there some risk factor there? Are all the materials off gassing? Is there mold in the building?
Mhm.
I mean, these aren't things that would prevent an operator from getting a mortgage, but they could, cause, serious harm to tenants.
Absolutely. Yeah, and that's if you look at the area that a project's in, if it's an area of town that's been around like New York City, that's been there, for a long time and been built up and torn down and built up and torn down, and I mean, each corner has been used for 100 different things over time, and you never know what's underneath the building, and and also if you're going out and developing on farmland that's never been built on, there's a lot less. It's not foolproof, but less risk associated with environmental concerns.
Potential, I mean, but even farmland, there's a lot of toxic
Sure.
fertilizers
Well,
that have been used, and those
I
can cause harm.
I would say like underground storage tanks out on farms would be a pretty big issue as well. But hopefully those are identified. Um,
Absolutely.
But yeah, let's switch gears here. How did you get into real estate? And there's a fun fact about Aaron that he got a 70x return on his first real estate investment in Jersey City. So I want to hear all about that.
Okay, so let me I can kind of back into it in terms of how does an artist get into real estate? Well, uh, artists need space. It's kind of a critical factor. You need some space to make work in. So every artist is looking for space, and if there's any possibility of actually buying that space, that's sort of the ideal scenario. But to back up a little bit before that, so I'd moved to New York. I was living in Brooklyn, and I was looking for someplace to move to, and there were a few reasons why people had recommended looking in Jersey City, which is just across the Hudson River from Lower Manhattan. So I went over there, and I was looking at some apartments to rent. And at the time, this was some years ago, there was something that was unique in Hudson County in northern Jersey that didn't exist in New York City, which was called an MLS. There was no MLS at the time in New York City. You had no idea what was listed, who was listing it, what was going on with any properties. Because I'd already started, looking for some properties in Brooklyn. Part of this was, my father was encouraging me to look for properties. His father, my grandfather, owned some multifamily buildings in the Boston area, so there was a little bit of maybe a gene pool there. Although it skipped my father, he invested passively in a few real estate projects, but never actively. So I was in Jersey City, waiting for a broker to look at some apartments, and he's on the phone working on some deal. So I'm sitting in the chair, and there's a stack of these MLS magazines sitting next to me. So I picked one up, started flipping through it, and there's a few condominiums listed just where I'm looking for apartments. And I can tell you, the apartments that I was being shown, they were terrible. And And looking at the prices, I was very able to quickly determine that I could buy an apartment for the same price it was going to cost me to rent an apartment. So I was looking to rent at, first month's rent, last month's rent, security deposit, and broker fee. Right. So this is like give you the real hard numbers. At the time, the apartments were around $1,000 a month. So it was $4,000, right, to get in. In the apartments that I was looking at, they were mostly in the range between $80,000 and $100,000. That's all they were at the time, right? And you could buy with 10% down, or maybe even less. So I looked at a few apartments and just you know made a quick decision. Found one I liked, and I was like, all right, I'll take it. Full asking price. It was listed for $79,000, so I'll take it for $79,000, right? And I was able to actually buy it, and my attorney at the closing gave me a little bit of money. I included closing costs in the mortgage. And my attorney was able to somehow, I don't know what happened with the numbers. He gave me a little bit of money back. So in the end, I spent about out of pocket about $5,000 to buy the apartment. Of course, there's a mortgage on the rest of it, but that's all I had in, if we look at it as a deal, I had only $5,000 in the deal. That was it. And then I didn't have to pay my second month's, I didn't have to pay the rent because you pay your mortgage in arrears, right? So if you're looking at it for what I was renting, it would have been $4,000, and then the second month I'd have to pay the mortgage. I'd have to pay rent again, $5,000. So I paid $5,000, and then I kind of skipped a month and then paid the mortgage. So basically the exact same cost, and what I was then paying for the mortgage and the taxes and association fee was less than the apartment I would have rented. It was ending up being something like, I don't know, $700-800, like 20% less. It just happened that that's where the metrics were at the time. So, I would say I did get a little lucky because this was a strong growing market at the time that people hadn't really, gotten into so quickly. So within a couple of years, and this is kind of a classic story. This is how you get into real estate and how you grow, right? Bought the apartment, and prices started going up fairly quickly. I then, bought another building. There's another story related to that. But shortly after I purchased it, I was able to take money out of it. And at the time, it was a little easier than it is now. This is before 2008. So, it became a way that I could draw equity from this apartment. Again, that I paid no more for than I would have paid if I was going to rent an apartment, where I would have gotten no equity accumulation, none. So here I've got this equity accumulation. Shortly after, within a couple of years, I was able to take equity out of the apartment and invest it in something else. So, okay, how do I get to a 70x return? So just looking at it, yes, I paid, the price was $79,000, right? I had $5,000 in the deal, and I sold the apartment, and this was after renting it. I held it for probably longer than you should, but I rented it for quite a while and made annual income that was decent. And I then ended up selling it for $420,000.
Wow.
So I put $5,000 in it, pulled money out of it more than once. I think 3 times I pulled money out of it, continued to pay down the mortgage. So I'm pulling money out, kind of paying down the mortgage a little bit, pulling money out, and then selling it for $420,000 on my $5,000 investment. Wow. That gets you to a 70x return. And it honestly, the character that I bought the apartment from had renovated it, and I hardly put any money into it.
Wow.
It was the only thing is I suffered with some neighbors that were a little bit difficult, and the block was a little maybe a little less than some people would want, although it's fine now. So I suffered through that a little bit, but there was a very big pot of gold as part of the process.
That's awesome. That's super interesting, and that's something that I really wish I would have done earlier in my life. Was it's almost doing the buy, live in it, then rent it out, buy new, and just move on that direction.
I mean, I think that I think that it might be challenging now, depending on the
Hmm.
market that you're in. Prices are different. There's different things going on. So you need to look at where things are at. But, this so-called kind of house hacking
Right.
is still a very reasonable approach because there's
Uh,
multiple benefits of buying a duplex and living in one and renting out the other apartment as a way to subsidize your mortgage. And it's still an owner occupied building. You could buy a three family, it gives you two, and it's still owner occupied. So you still benefit from everything that's involved with an owner occupied purchase, but you have income that's coming in at the same time. And also, if you're a little industrious, if you buy a property that maybe it is 3 units or 2 units, and one of them's in reasonable condition, you move into that one, and then you can renovate the other one, and then maybe you know switch it out if the apartments are the same, and that works for you. There is a little effort involved, and
mhm.
it's not for everyone, but anyone can do it that's
Right.
looking to buy something. And then that's also, once you improve it, then you've got more equity. There's imputed equity in it. You can take money out of it at that point.
For sure. Yeah, yeah, a lot easier to do when you're single or don't have kids. Uh but anyway, switching gears here. So you're focused on new development right now. Um what would you say what is your opinion on new development versus doing a value add multifamily investment?
That's a very good question. And there's not a kind of one size fits all answer to that because, there's a lot of different markets. If you're even just looking in the United States, obviously there's international markets as well that you could assess. So it's not a one versus the other situation. I would say that, my inclination is new development for some of the reasons that I already mentioned and some of the concerns that I have for existing properties. But I think that there is really good opportunities in value add as well. It's a different animal, though. It's a different thing to take on, and it can potentially be easier than doing new development, and it could also be potentially more challenging depending on what you might uncover in a property and what challenges you might face dealing with an existing structure. So there's definitely things that are very important to consider and to actually physically look at and get inspected. Structural, being on the top of the list, of course. In terms of opportunity, in my local market, the value add is for larger apartment buildings is a little bit more challenged because in most larger older apartment buildings in Brooklyn and also in a lot of parts of the city, there's different regulations that apply to a lot of the units in the buildings. And that creates other layers that affect value and what you can actually do with the properties. You can buy up to four family buildings where the apartments are all free market. There are some larger buildings you can buy in the city, of course, that are all free market. Those tend to be newer though, and they're under different classifications. So there's definitely different challenges, working in the New York City market for larger multifamily. And with some of those layers, it's definitely one of the reasons why in my market, I tend to move away from those because they require a business strategy that's involved with moving tenants out and trying to increase the rent to the maximum amount, which is often the case in other markets as well, that you need to move tenants out and then start to renovate and increase rent. So it can work. There's definitely projects that make perfect sense for it. I can give you an example. I have a colleague that's located here in Brooklyn who's working in Detroit. His focus is in Detroit, and he's found a completely abandoned building. I mean, it's Detroit. Okay, there's a lot of abandoned buildings, and he's so the purchase. If I'm remembering the numbers correctly, something like $300,000 to buy the entire building. He's investing with an investor $2 million to renovate the entire building, and that will then just supercharge the value of the property, because once he's done with that significant investment, uh, the whole entire building can be rented. It will be essentially completely new up to that level. And then once the building is rented, you can get a refinance all the investment out of it, and you've got a cap rate valuation on the property. And the rents are actually at this point, they've even in Detroit, they've increased. So you can take one of these older properties in markets like that, and put that kind of investment in it and come out with a significant amount of equity within 12 to 18 months.
Wow.
So there's opportunities in many different markets.
Mm-hmm.
And I think, I looked at, he showed me the property, and it's a property that does not need to be torn down. I don't
Mm-hmm.
think every property needs to be torn down. It's a nice, solid brick building with some deco detail, but certainly it needs to be fully gutted with all the infrastructure inside of it and all the systems, mechanicals fully replaced. And then you should have a nice building when he's done.
Yeah, and that's a lot easier when it's already vacant and you're not
Exactly.
moving. Yeah,
Yeah.
that's
Right. That's a full value add. So there's different levels and layers to it. And, again, anyone that's interested in investing should really look at, what the business plan is, if it's a value add play, right? Because I mean, I've been using this as an example recently. I looked at a deal about a month ago, I would say, in a market in the South. And once I dug into the details, it really looked like the business plan was predicated on raising rents for all the apartments by about 6.5% annually over 5 years. And that just doesn't strike me as a business plan
realistic.
that's going, well, one, it's not really a very nice thing to do to your tenants. Um, People will have to move out, and maybe it's not an ideal time for them to move out. Maybe there's other things going on in their lives. Maybe they should get the same rent for a couple of years. Maybe that's the right thing to do. And also, is that feasible right now in some of those markets to get that's like a 30+% overall rent increase over 5 years? It's crazy. They'll do
Yeah,
well on the investment, though, even if they don't get to that point. But I think that there are better approaches to your business plan.
for sure. So, I'm always looking at different, risk profiles and looking at a 90% occupied multifamily building that you're investing in. There is a value add plan, but the thing is already operational. You can improve management. You can improve, the facility, bump rents up. There's something there. It's already operational versus a ground up development. What are some of the risks in doing new construction? What just off the top of my head is, what if it doesn't make it to construction? That's a big one.
There's definitely risks, and there are more risks than purchasing an existing cash flowing property. And I think for most people trying to get into this space, purchasing or partnering with people to purchase a larger multifamily cash flowing asset is definitely a very reasonable approach, because you don't have all of those risks, particularly if you're cash flowing the property from day one. Even if it's not great cash flow, you got a little bit of a buffer there that allows you time and space to execute your business plan, whether it's some capital expenses to improve the overall property that would allow you to increase rents, or actually really doing significant or full gut renovation on the apartments. But there's cash flow coming in from the occupied apartments that is stabilized the investment, that doesn't require you to continuously dig into your pocket to pay for a longer period where you have to hold the property. So, and that's where a lot of the risk factors come in, right? How long could that possibly be before you get from where you entered the project to where you can exit the project because there's no cash flow coming in. Can you really assess all the risks that are going to happen that won't, one, from what you're saying, completely derail the project, right? Which would be, a total disaster, or just extend the project or significantly or diminish the project in some way during that period from purchase, from the entry point to the exit point. So there's a lot more that can happen there because there isn't any cash flow coming in. But you have an opportunity to completely reinvent the site and build
Sure.
something that's new. And I think that's a very exciting approach. So yes, there's more risk, but the possibility of really developing something that's a unique and superior product definitely motivates me. But okay, that's a
Yeah.
side point. My motivation. You're concerned
Sure.
about the risks, right?
So, from an investor standpoint, because I agree with you, I think making sure that it's a project that you believe in and like, and you're not just looking at numbers. But from a numbers perspective, is there more upside on a new development versus a value add, or is it typically about the same?
No, that's a very good question. So, I mean, we can just break it down. I think investors should expect the highest return on a new development project, and depending on how it's underwritten, the return profile on an annualized basis should be over 20%. Which, of course, based on the risks, maybe it doesn't hit that. But if it does really well, it could do even better than that.
Mm-hmm.
So there's where you're talking about. You're looking at these types of investments. It's a risk reward situation, right? You're taking a little more risk and the reward is higher. You can step it down to the next level of risk, right? Where it's a significant value add, heavy rehab on a large multifamily. That should produce a return, IRR, annualized return in the high teens. And then you can, kind of step it down from there. As a next level, you can purchase, let's say, a B minus property, and maybe there's a little bit of a capex expense to take it to a B or B plus. Maybe in that type of property, you might look at a 14 to 16% IRR, and then from there you buy a fairly new Class A, fully cash flowing property that's in a good location that's just totally stable. Well, there's very little risk in that, right? You can calculate everything about it. If you buy it at a price that allows you to get what would be a reasonable return, which should be then maybe somewhere between 9 and 12, maybe 13%, on IRR on an annualized basis, then you have a perfectly safe investment. There's no risk involved. You can get monthly or quarterly cash flow, and you don't have to think about it. No, there's no worry in that. So there's kind of the
Tiered,
the tier in the kind of return profile that you're looking at. And if you have some money to invest, what really makes sense is to split it up a little bit. If you're taking the least amount of risk on all of your investments, well, you're going to get the least amount of reward. But if you put some of your investment dollars into a less risky investment, you can count on that. You don't have to think about it, and then take some other funds and put it into a more risky investment. Look, if you've got a new development project you're looking at that's projecting 20 to 25% annualized returns, and it does 18 or 19 in the end, you're still significantly above what you're going to get from that completely de-risked cash flowing Class A multifamily.
Right.
So you
Diversification.
still get more reward. Maybe it's not what you expected, but you could maybe get 27%.
Yeah.
But so that's where the return profile comes in. But clearly there's due diligence that's required, or you need to meet an appropriate operator that can identify the right other operators, the sponsors to invest in, like yourself, that can I look at and do all the due diligence and present investment opportunities to people where they don't have to dig into all of those details, because there are definitely people out there that can present opportunities to people that know how to do the due diligence,
Right.
and they're doing it for you.
For sure. Um, Speaking of risk and due diligence and the current state of the market, what would you say about people um, that are looking to invest but see a looming recession or some economic headwinds ahead?
That's definitely, the question of the day, right? Everyone's thinking about this and asking about this. Well, where are we going to be at in 10 months or 6 months, 10 months, 12 months, 18, 24 months? And what should I invest in now? Or should I invest in anything? Should I just keep my money in the bank and, wait until conditions improve? I think that to start with, this is a very personal decision for people because some people just cannot stomach any risk whatsoever.
Sure.
And you can leave your money in the bank and it'll lose value because, inflation is higher than what the bank's paying you. And if that's where your comfort level is at, that's fine. But there's ways you can look at investing now, even though there's potential headwinds that will certainly outperform that. That you can look at and really take a risk adjusted assessment of and determine that, okay, maybe this investment doesn't do 18%, maybe it does 11% or 12%, right? And I think for any operator that's worth their salt, that's projecting a 17 or 18% return that only gets 11%, they're going to be pretty embarrassed about it. But
Right.
still, even if that's what they've done, right, that's what they've returned to you, you're still well ahead of inflation and you're well ahead of what you would get if you just kept the money in the bank. And you're also in a project when you're in real estate, you've invested in an asset that has value. It's easy to invest in stocks, right? In and out, right? Maybe you think you can, day trade and do really well, but it's very easy to lose money that way. It's much more of a casino style approach than investing in real estate, which is a slower moving investment that's really built on solid assets that have inherent value. So okay, let's step back for a second to get the initial point
Mhm.
of the question. Is now a good time or not a good time to invest in real estate? I think that in most markets, there are good investments to be had in real estate. And I actually think that right now, there's opportunity where there are distressed assets or there are seller or maybe they're owners that become sellers, maybe reluctantly become sellers, or that are willing to sell, where it's possible now, because there's already been an adjustment in most markets across the country, where it's possible to get in and transact at a level where you can underwrite and see where the value is going to be in a few years. And are we at the bottom or not at the bottom? We're certainly not at the top anymore. I think that's pretty clear. And you can look at real numbers and real comparables and determine that we're not at the top. So are we at the absolute bottom? Well, real estate's slow moving. So are you going to buy in at the absolute bottom? Do you need to? I think that's really the question people should ask. Do I need to buy at the absolute bottom, or do I already understand clearly that there's been a market adjustment? Prices are lower. And if I can find the right investment, the right deal, that this is a good time to get into it because for the most part, all of these investments are going to be longer hold periods, 2 years probably minimum, but more likely 3 to 7 years. And if you project out, the recession's not going to last 3 years. It's not going to last 5 years. It's going to be much shorter than that. And at the other end of the recession, you can look at what's happened historically. Prices will go up. There will be an adjustment. So if you can buy in now at a reduced basis because there's already been a correction, and you're buying into a solid asset with a solid business plan and an experienced operator, now's a good time to look for those opportunities.
I agree. Yeah, I'd say just about all the opportunities that we have right now, or that we've had this year, are investments that were under contract this past fall and fell out of contract due to the interest rate conditions. And so, yeah, you're right. There was an adjustment, and it created opportunity where the operators that we're working with were able to come in, had their eyes on the property, fell out of contract, and all of a sudden they can swoop in and pick up the property at a reduced basis. So
I think right now in the current market, it's more about being ready to take advantage of some of those potential opportunities, and also knowing how to do it. I was in contract for the project that we discussed, the 10 unit project, for quite a while. And clearly the market was moving in one direction during that contract period. And I retraded it. I got it down about 9%. I was trying to get it down a little bit lower than that, of course, but a 9% reduction was, on my basis getting into the project was terrific.
Yeah.
Definitely set up the project in a better position. So that kind of thing is possible.
Yeah. Yeah. That's very good points. I think that we're seeing opportunity, and there's more opportunity ahead. And I think, personally, I've been a very big advocate of, really obviously doing your due diligence, but time in the market versus timing the market.
I mean, look, you look historically at real estate in the United States. Yes, there's been some ups and downs, but you can look at the trajectory over time, and it's very, very clear what's happened over time. So even if you buy now and the market softens for 12 months, maybe you have to hold the investment for another 12 months to hit the projections. Still, if your projections are 18% IRR and then you end up at 14% because you held it for another 12 months, I think you're still coming out really, really well in the end, again, right, as compared to other types of investments. And this is really the difference, because some of those are literally, it's the stock market is a little like a casino. You have a lot less control over it.
I agree. Absolutely. Well, Aaron, I really appreciate you coming on this podcast and sharing your story and knowledge with our audience. I'd love to have you back on and hear about how the development turns out. Yeah, man, really appreciate it.
Yeah, let's do that. And I think the project will be further progressed, and we can dig in to the design discussion a little bit more, and that would be great to do.
Awesome.
I would love to connect with anyone that's listening that's interested in hearing a little bit more about what we're doing here in Brooklyn. And I would invite you to just send me a message. You can take a look at our website, which is Hive Developers with an S.nyc. So please log into hivedevelopers.nyc and go to the contact form and send me a message. And I'd be happy to set up a phone call and discuss the kinds of things we're doing here and give you a little bit more information and see if what we're doing is maybe a good fit for you. And if not, that will at least allow you to learn a little bit more about the types of investments that are out there. And that kind of education is always really valuable as you make investment decisions.
Reach out to Aaron. He's on the socials as well. And thanks for listening to this episode. And remember to let us help you find your passive income superpower. Thanks.
Thank you for watching the Passive Income Power Podcast. We hope you gained wealth building insights. I will ask you to do 3 things to help us serve you best. Go to our website at 2dinvestments.com, click on Investors Club, and fill out the basic information to have timely access to new offerings. 2, follow us on Facebook, Instagram, and LinkedIn. And 3, feel free to set up a call with Doug or Mickey through our website. We would love to help you find your personal superpower.